Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello and welcome. I'm Stephen Boland. Artificial intelligence continues to advance, and more use cases for it are being developed. This year, investors have responded by selling stocks that could be at risk of AI disruption. Companies where profits could deteriorate or where the whole business model could become obsolete. Thus far, the stock market has largely been shooting first and asking questions later. That's an environment that can create opportunity, as certain stocks could become unfairly punished. Some businesses will be negatively impacted by AI, but others will prove more durable. Today's guest, Trevor Chang, is here to talk about a company he thinks will be more durable, and that's Moody's Corporation. Thanks for joining, Trevor.
Happy to be here.
So, Trevor, people in financial circles generally know Moody's pretty well, but it's not exactly a household name. So can you start by telling us what exactly is Moody's?
Yeah, so there's really two components to Moody's. The first one is the credit rating agency. That's about 70% of Moody's profits. It assigns ratings to bonds. These ratings are used by investors all over the world to make informed lending and investment decisions. The second part of Moody's is the software analytics research side. And basically, all they do there is sell financial tools under a subscription model. And this is a highly recurring revenue business.
So credit ratings, it's like we give recommendations on stocks. They give their view of a bond's credit worthiness. In terms of the software business, can you give us an example of the type of software they sell?
Yeah, so they sell things like data for the weather, for example, and insurance companies would use it to, analyze, how much losses they might have, right? They also sell things like the KYC software, so know your client, and it's really compliance software which allows firms to understand who they're doing business with. Moody's has a large proprietary database that connects all the dots together.
So they have a giant database of past weather patterns?
Yep, they do.
Oh, interesting. I did not know that. So Moody's is a very profitable business, very high profit margins, high returns on its capital. Why is it so profitable, and how likely is that to endure?
I think they have a very high quality business. I think there's three main reasons why they are so profitable. The number one reason is that it's a global duopoly. Moody's and S&P combined have 80% global market share. This market share has stayed pretty stable over time, despite negative headlines, lawsuits, and increased regulation. So it's very unique. That kind of durability is rare. The second reason why Moody's generates such healthy profits is that it has high entry barriers. Moody's credit ratings have been around for 115 years, I think. So it's taken them a long time to establish all that credibility. And it's very difficult for someone new to just show up, start rating bonds and developing that credibility. When Moody's assigns a AAA rating, investors understand that as having very low default risk. And, when you think of a new entrant coming in and assigning a AAA credit rating, do you have the same level of trust?
Trust doesn't happen overnight.
Exactly. And the third reason why we think Moody's is a high quality business and why it's so profitable is really the pricing power embedded in this business. So the way the revenue model works is that if a government wants to issue bonds, they typically would go and get a credit rating because a lot of investors need credit ratings before they can buy the bond. So for the governments, for example, who go and get a credit rating, they get to save on their interest expense. And the fees that Moody's charges is really only a tiny fraction of the interest savings that the governments would get. So again, it's a super attractive value proposition for any issuer, governments, corporations, financial institutions. And that's why Moody's has potential to increase its prices over time.
So the borrower, in this case, the government, borrows money. They get a credit rating. They pay Moody's for a credit rating. And then in return, people are willing to lend the government money at a lower rate. And the money the government saves, a small fraction of that goes to Moody's, but everybody kind of wins, you could argue.
Yes, no, that's exactly how it works.
Okay. So let's just go back to that point on trust. Going back a little ways here, but I remember the great financial crisis. Moody's was really taken to task after that. And people believed they had a role in what ultimately became a very deep housing downturn in the US and the financial crisis. And they were essentially accused of giving overly positive ratings to mortgages. So they told people the mortgages were better quality than they actually were. And there were a lot of factors that led to the great financial crisis. But I remember Moody's reputation really took a hit. Where's their reputation today? How did they get over that? And is it something we should be concerned about going forward?
Yeah, so look, this is a really important part of Moody's history. I mean, certainly we are well aware of that. And, I think following all of those events, it's led to lawsuits, increased regulation in the industry. We think Moody's is doing a good job on the ratings today. They're not engaged in the behaviors that they did in the past. In fact, one of their smaller competitors is actually engaged in that behavior today, and they're getting investigated by the SEC. So the regulators are much more prudent today. They're cracking down on that behavior. And we think Moody's is not making basically the same mistake they made in the past. So that's why we're optimistic.
Companies learn from mistakes, and it's been around for more than 100 years. So yeah, okay, there was one questionable period, and it's good to hear that they're not doing it today. And if others are, it could actually ultimately bolster the reputation of Moody's going forward, which is good to hear. I'm kind of curious on growth. It sounds like a really profitable business, but it has been around a long time. They have a big market share. Where do they grow from here?
Yeah, so Moody's growth is really tied to global debt issuance. So that's basically new debt issued by governments, corporations, and or financial institutions. A lot of these investors require a Moody's credit rating. So Moody's is very essential. And one way to think about the growth of Moody's is really in line with this factor. Moody's, another way to think about it, I guess, is also that Moody's is a tax on global debt issuance as well.
So can you talk about the cyclicality of global debt issuance and thus Moody's business?
Yeah, like this business is cyclical. When the economy slows down or interest rates were to rise very quickly, debt issuance typically slows down. But there are natural floors in this business. Debt comes due every single year, and typically debt's not paid down. It's usually refinanced. So what that means is that new debt will be issued to pay the old debt, and the new debt will require credit ratings as well. So there's always this natural floor in the business.
Okay. Just back to the growth question again, and it sounds like they can grow as debt issuance increases over time. What else is going to drive growth in this business?
Yeah, so I think earlier we talked about pricing power.
Yeah.
That's a lever that they can pull. And also, Moody's generates so much free cash flow. And in 2026, they plan to return 90% of that free cash flow through dividends and share buybacks. So share buybacks will also accelerate the earnings per share growth of Moody's. And the combination of volume growth on the debt side, increased pricing, And the share buybacks will ultimately drive Moody's earnings over time.
And what does that add up to? What sort of rate of growth should I expect?
I think in our models, we estimate about 10 to 12% a year. And we think there's good likelihood that they can probably do that in that range.
Okay, that's a very good growth rate, certainly above average. So I want to touch on, I referenced at the beginning of this podcast that AI, artificial intelligence, and the potential disruption to business models is on the minds of a lot of investors. And we talked about how Moody's has a big software business. I would imagine that artificial intelligence platforms could come up with their own credit ratings. How much is AI a risk to Moody's business?
No, I think that's a fair question, and certainly why Moody's has sold off recently. On the credit rating agency side, there's concern that AI can replicate these ratings. But earlier, we talked about trust and credibility, and Moody's has developed their reputation over 100 years. I think it's very difficult for investors to suddenly give up on that and trust these AI created ratings. How can you be confident that they're right? They're 100% right. But with Moody's, I think investors have more comfort around that. On the software side, certainly, I think there is concern that AI can replicate a lot of the software that Moody's sells. But to counter that, Moody's has a lot of proprietary data. A lot of their software is mission critical, and it's very deeply embedded in customer workflows. So it'll be pretty difficult for firms to suddenly rip that out and replace it with an AI alternative. And so the combination of that is why we're more optimistic on Moody's going forward.
Okay. So I guess lastly, you've certainly considered some of the risks. They sound manageable, very profitable business, growing at a nice rate. Part of the equation of investing is you want to own great businesses that are growing, but you want to get them at a sensible price. And you don't always get that. If everybody appreciates something great, you often have to pay for it. How do you think about Moody's valuation today?
Yeah, so when we first bought Moody's, I think we paid about 24 times earnings per share. We think that's a reasonable multiple. Again, we talked earlier about earnings growth, and we think that's about 10 to 12%. So this is really just a high quality business at a reasonable price.
Yeah, a small premium to, I think, the general market and for a much better business. So thanks, Trevor, for joining us today. I think that was a good discussion about Moody's. I know when I think of Moody's, I think of Warren Buffett, not just because his company, Berkshire Hathaway, has owned a large stake in Moody's since 2000, because I've often heard Buffett preach the benefit of buying a great business at a fair price. And that is what you just described here. A tremendous business, and because of some broad market concerns, it can be bought at a reasonable price today. So thank you all for listening. Certainly hope you're staying well, and we look forward to talking again soon.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.